Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today, we have a crucial topic to discuss that's been on the minds of many homeowners. What taxes do you pay when selling a house in Ontario? With recent news about the Canada Revenue Agency uncovering $1.3 billion in unpaid taxes in British Columbia's real estate market, this issue is more pertinent than ever. Let's dive into the specifics and break down what you need to know. First, let's talk about the general landscape. The Canada Revenue Agency's recent audits revealed approximately $957 million in unpaid income taxes over 8 years, specifically targeting the provincial housing sector. This report, which captured national media attention, highlighted a disproportionate amount of non-compliance in major urban centers, especially in Metro Vancouver. This has left many Canadians, including those in Ontario, wondering if they are compliant with tax regulations and what they should expect when selling their homes. So, what taxes do you pay when selling a house in Ontario? Since the federal government updated its capital gains tax rates, many Canadian homeowners have been concerned about facing a capital gains tax on their homes. The good news is that these new rates only apply to recreational properties, not principal residences. This has been a relief for millions of homeowners who feared receiving a huge tax bill once their house was sold. Let's break it down further. If you're selling a recreational property, such as a cabin in Ontario's cottage country, the capital gains tax comes into play. A capital gain of more than $250,000 will now be taxed on 66.67% of the gain as income, up from the previous rate of 50%. This means that if you sell your recreational property for a significant profit, you'll owe more in taxes. However, if you sell it for less than what you originally paid, you can file a capital loss to reduce your taxable income. This is something best handled by a tax accountant or an expert at the Canada Revenue Agency. Next, we have property flipping taxes. Since January 2023, any gains from selling a home owned for fewer than 365 consecutive days are classified as business income, not eligible for the capital gains inclusion rate. Additionally, you might need to charge sales tax on a newly built or substantially renovated home. If it's your primary residence, you can apply for some or all of the GST or HST paid. It's advisable to contact the Canada Revenue Agency to find out if you need to file a GST or HST new housing rebate application. Property taxes are another factor to consider. These are generally paid on a prorated basis, meaning you might still have to pay a portion of the property levies for the year when the transaction occurs. One more thing, the principal residence exemption. Ottawa has not mandated homeowners to pay a capital gains tax on the sale of their principal residence. However, you must still report the sale to the federal government and designate the property on Schedule 3 of your tax return. This step is crucial to ensure you remain compliant with federal tax laws. Given the Canada Revenue Agency's eye-opening report, it's clear that the agency is closely monitoring the real estate market. Experts suggest that buyers and sellers should act as if the Canada Revenue Agency is always watching. The Department of Finance has found that individuals often misreport data, especially regarding property flips, by claiming them as capital gains or applying for the principal residence exemption to reduce their tax liability. In Ontario, most non-compliance issues are related to unpaid GST and HST on new homes, or incorrect claims for rebates on those taxes. The Canada Revenue Agency is leveraging a wide range of tools, including third-party data and analytics, to accurately and swiftly determine compliance with federal tax laws. So, if you're selling a house in Ontario, it is wise to consult a tax expert and perhaps connect with a RE/MAX agent to navigate these complexities. Emerging fintech Fastkey is revolutionizing the mortgage and loan application process, providing lenders and brokers with efficient and secure access to vital Canada Revenue Agency documents. Launched nationwide in April, Fastkey technology allows lenders and brokers to access essential documents for mortgage or loan applications within minutes, including notices of assessment, income statements, proof of income, tax slips, and Canada Child Benefit details. By default, we do 2 years of those 5 documents for an applicant, says Sam Kajee, the company's president and co-founder. I have had brokers make bespoke requests, which I can fulfill as well. A commercial lawyer by trade, Kajee and his co-founders came up with the idea for Fastkey after identifying how hard it was for mortgage lenders and brokers to access the documents they need to facilitate a loan. To vet an applicant either for a commercial loan, a car loan, or a mortgage, they need Canada Revenue Agency documents, and right now the process is, unfortunately, very manual, he says. You email the applicant and say, I'm looking for 2 years of this, 2 years of that, please go get it and scan it and send it to me, which can cause a whole lot of problems. Kajee adds that asking clients to find, scan, and send the right documents can delay approval processes and even risk client relationships, as some may prefer to work with an existing provider like their bank to avoid the extra paperwork. Not only is the traditional process time-consuming and cumbersome, but it's also not very secure, since the documents aren't coming directly from the source. The problem is that you've lost this chain of custody that you want to maintain because you want to make sure there's been no tampering with the information, he says. With incoming regulations, there's a trend towards cracking down on fraud, and one of the things that Fastkey does is it directly extracts the information from the Canada Revenue Agency and directly sends it to the lender or the broker. Kajee adds that in a lending environment where face-to-face interactions are becoming less common, brokers and lenders need a way to quickly and securely access and verify customer data. While other providers have sought to offer similar services, Kajee says they accessed Canada Revenue Agency documents by registering for e-file authorization, which is intended for accountants filing taxes on behalf of clients. They were using a pathway which was never intended for that usage, and eventually the Canada Revenue Agency became aware that they had 1,000 authorized representatives on the account, but never filed a tax return or did any tax filings, he said. Those parties either had their account status blocked or authority to access the Canada Revenue Agency revoked. Fastkey instead seeks access to customer Canada Revenue Agency accounts as an authorized representative. Unlike e-file access, that only lets the company view and download Canada Revenue Agency documents without the ability to make changes or filings. Kajee adds that he has been in touch with Canada Revenue Agency representatives who confirmed Fastkey's approach was in line with the regulations set out in the Income Tax Act. Brokers and lenders can register for a free account on fastkey.com. Once the company verifies their lender or broker status, which Kajee says typically takes 20 minutes, they'll gain access to the platform's full suite of services, which includes criminal record checks, credit score reports, asset reports, income verification, and Canada Revenue Agency documents. Registering with the platform is free, but each service has an associated cost. The current rate for requesting Canada Revenue Agency documents is $19.99 plus tax, which Kajee says can be paid by either the broker or applicant by credit card. Lenders and brokers who select the option to request Canada Revenue Agency documents will be asked to provide the name, email address, and phone number of the applicant. We also have a customized box where they can write a personal message so that the legitimacy of this request coming from your broker is acknowledged by the applicant, Kajee says. Borrowers then receive an email with step-by-step instructions, as well as an instructional video, for logging into their My Canada Revenue Agency account and giving Fastkey authorized representative status. Those without a My Canada Revenue Agency account will also be given instructions for setting one up. Once they certify that they completed those steps, and assuming they actually did, we get a notification on our backend, and it automatically pulls exactly what the mortgage broker or lender had asked from the Canada Revenue Agency and sends that information to their dashboard, Kajee says, adding that it typically takes about 20 minutes for the information to appear. Fastkey recently engaged in a 90-day pilot program with Newton Connectivity Systems Velocity Operator Platform, which invited a select group of 100 brokers to use the tool for free. In that time, Fastkey and Velocity will be working together to learn some best practices, Kajee says, adding that the aim is to expand access to the rest of the platform's users after the pilot. Furthermore, while the service is currently limited to individual borrowers, Kajee says he hopes to offer the same capabilities to commercial clients in the future. We also want to start thinking about how to help brokers address incoming regulations, he says. Identity verification is one solution that we've implemented to try to address incoming regulations relating to Know Your Client, and we will explore other solutions that might be available once we fully understand the legislation that's being enacted. In our final segment today, we are diving into a rather bold opportunity for those looking to enter the Toronto condo market. If you're feeling adventurous, this could be your time to snag a great deal on a new condo in Toronto. Let's get into the details. Toronto's condominium market is currently facing significant challenges. Prices are down, sales are at multi-decade lows, and many owners are selling under duress. This is particularly true for pre-construction buyers who now find themselves financially underwater. While this is bad news for sellers, it presents a unique buying opportunity for those looking to get into the housing market, especially with builders offering unprecedented incentives. During the pandemic, many Ontarians bought unbuilt pre-construction condos with the hope of selling them for a profit once they were completed. At the time, it seemed like a smart move because interest rates were low. Buyers would put down a deposit, which the developer held until the condo was fully built and registered under the buyer's name. But now, with condos ready for occupancy, the market is shaky and buyers are waiting on the sidelines. People are really hemmed in by high interest rates and high prices. The original purchasers are now stuck with fully built pre-construction units they can't afford. To offload these condos, they need to sell them on assignment, which allows them to transfer the rights and obligations of the original purchase agreement to another buyer. Some are even dropping the listing price and selling at a loss in the hopes of attracting buyer interest. It is currently a buyer's market, and there are deals to be had for those willing to do their research. There are plenty of fully built pre-construction condos on the market today. For example, one listing is a two-bedroom unit near the Wellesley subway station in Toronto, listed at $978,900, the same price it was bought for in 2019, before the pandemic. The seller is essentially selling at cost due to the current market conditions. Some sellers are even more desperate. One broker has a listing for a pre-construction buyer so eager to unload the condo townhouse that they are willing to walk away from a $94,000 deposit on a $947,900 two-bedroom unit in Scarborough. The property is now listed at $854,000. The buyer was initially hoping to flip the property for a profit, but is now on the hook for the remaining purchase price if they can't reassign the agreement. The market downturn and rising interest rates have left them in a tough spot, but this is an outstanding opportunity for anyone willing to buy. Builders are also offering unprecedented incentives, such as discounts of up to 8% on purchase prices and mortgages with lower than bank interest rates to attract buyers. However, if you're bold enough to purchase a pre-construction condo through an assignment sale, it's crucial to work with an experienced agent and hire a lawyer who's an expert in the field to review both the original and the assignment agreements. Familiarize yourself with the original agreement of purchase and sale, or APS. It's important to know when the property was originally bought and for how much. Also, know what incentives, discounts, and price reductions the original buyer is offering and how these factors affect the overall value of the property. You'll need to be aware of various closing dates: the assignment closing date, the occupancy date, and the final closing date. There will be a period when a pre-construction condo is in limbo. It's built, the owner has the key, but the property is still under the builder's name, not the owner's. Until the property is registered under the new owner's name, the builder still owns the place and essentially serves as the landlord. The original buyer of the condo is the tenant. During this period, the builder expects the buyer to pay rent or occupancy fees, which can be high, so make sure they're part of your cash flow calculations. If you purchase an assignment, these occupancy fees will be passed on to you. Watch out for the assignment fee. In most cases, it's covered by the seller, but if you're not careful, you might end up paying it. Check with your lawyer. You'll also need to set aside money for closing costs, such as land transfer taxes and legal fees. There are development charges too, which can be quite high, ranging from $25,000 to $30,000 or more. Check the original purchase agreement to see whether these charges are capped and if the cap carries over to the new agreement. Additionally, you may need to pay a harmonized sales tax rebate up front, but you can claim it back on your taxes if you qualify. You may also need to pay capital gains taxes when you eventually sell the property. So, make sure you're fully aware of all the potential costs involved before diving in. If you want to cash in on some assignment deals, you may need to act fast depending on what happens with interest rates and the real estate market. Later in the year, the market could pick up, and owners might decide to hold on to their pre-construction units rather than selling them at a loss. With a couple more rate cuts, things could change significantly. By the end of this year, the market might be in a better position than it is now, and you'll see the deals drying up. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found the information useful and insightful. Stay tuned for more updates and expert advice in our upcoming episodes. Until next time, I am your host, Steve Hamoan. Thank you for tuning in and take care.